Doing business in Africa. You can't afford to be without Africa Investor.
Good evening, everyone. I'm Alessandra Sgobbi, head of the Climate Finance Unit of the European Commission's Directorate General for Climate Action. It's a great pleasure for me to welcome you all to this very late evening side event on making finance flows consistent with a pathway towards low greenhouse gas emissions and climate resilient development. I'm joined here by a very distinguished group of panelists that I will introduce in a little while. I wish to really thank you for being with us today. I know it's very late. I hope we'll have a few colleagues online, even though it's a Sunday afternoon or evening or morning, depending on the zone of the world that colleagues are connecting on. It is a really important topic that we are addressing today, one that is very dear to the European Union, and one that we find is instrumental and necessary in order to meet the goals of the Paris Agreement. We are standing here, of course, on day 3 or 4, I don't even remember, of COP28. We've had a couple of years of discussions around the new collective quantified goal that developed countries and parties will have to decide upon next year, all the parties to the Paris Agreement. And of course, that is a very important discussion that we're having, one that we hope will also shed some light on how we can make finance consistent with the goal of the Paris Agreement. It's quite clear that the scale and urgency of the challenge and the climate emergency, of course, cannot be addressed by public finance alone. And so we need really to mobilize a broad range of actors to work in the same direction towards achieving the goal of the Paris Agreement. Of course, the European Union is committed to continue supporting our partners, and for the last few years we have and continue to be the major contributor to climate finance internationally. We've just released our new figures, and we're very proud to say that we have been providing with the member states 28.5 billion in climate finance, and for the very first time we have been able to report on how much finance we have mobilized thanks to our public support, and that's around 12 billion. Of course, this is a drop in the ocean, and we still need other parties to do the necessary, but we also need to broaden the discussion. We must start taking seriously the role of the private sector when it comes to financing the transition and the transformation that we need to see. It's really about making domestic policies conducive to leveraging and mobilizing and attracting investments. It's about, of course, reforming international institutions, and it's about taking a systemic approach and a comprehensive approach to the landscape around climate action. I think in the EU, we have been, in the last 5 years or so, setting in motion a whole series of policy instruments that will help us shift, we hope, private capital towards the sustainability that we need to see. And this is, of course, enshrined in the sustainable finance strategy that we have nearly completed, and it's resting on 3 pillars. First of all, defining what is a sustainable investment, and under that, of course, also what is climate change action, and this is done under the taxonomy, but it's also about enhancing transparency through disclosure. And finally, it's about making sure we have the tools that we need to set benchmarks and make sure that we do not have greenwashing or wishwashing, no, wishful thinking, and we have the instrument we need to also assess not only the goals, but also the transformative and the action that private sector will want to put forward. I think it is clear that capital is out there. We've heard, I'm sure, the last few days and after the reports of the IPCC that the trillions are already invested in the capital market, but they don't necessarily go to the right investments, we would say. We still see quite a lot of investment flowing to fossil fuels, of course. We see a lot of subsidies, direct and indirect. How can we jointly shift all this existing finance is definitely a question that we need to ask ourselves.
Yes, no, thank you very much, moderator. I think, what did you say, Uganda to central banks to
the world.
To the world. I'm going to bring us down to earth.
Excellent. That's exactly what we need.
And on earth, where I reside with my constituency of pension funds and sovereign wealth funds, which collectively represent over 150 trillion US dollars of assets that are very interested in investing at scale to support Africa's $3 trillion worth of nationally determined contribution in climate transition-related investment needs. We've identified some very fundamental problems. Firstly, the name of this event is symbolic of one of the mistakes that the entire community are making. This whole climate agenda is being perceived to be a finance agenda. It is a long-term investment agenda. It's a multi-decade agenda. So unfortunately, our governments are being educated that this is a finance agenda that development finance institutions and multilateral development banks have the capacity to solve. Now, multilateral development banks have a collective balance sheet of $1.5 trillion. Can never do scale. I sit on President Macron's finance and private sector task force for the new financial pact. We all understand that even if the reforms are instituted and they surpass all of our wildest expectations, the MDB market will never be able to mobilize more than 10% of the financing gap. So my colleague here is part of the Ministers of Finance for Climate Coalition, and the young lady here is talking about the central banks. We, as the institutional investment community, have tried several times to engage the Coalition of Ministers of Finance with its secretariat at the World Bank. The calls don't get returned. The emails don't get returned. There's not a willingness to engage. I've just come from a meeting now where we're talking about central banks and greening the financial, the banking, the financial system. They're talking about taxonomies. How can we use taxonomies to mobilize climate finance? I said, that's really, really interesting. Is it your money or is it real investment that you're looking for? Because the last time I looked, there's a huge gap, and a $1.5 trillion balance sheet can never leverage enough money to close this gap. And we say to our governments, you're spending 90% of your time with a constituency on the private capital mobilization at scale agenda that can only deliver 10% of the gap, at best. And you're spending less than 10% of your time with the institutional investment community, 150 trillion pool of capital that can solve 90% of the gap. So we actually think that there's a fundamental problem there. And I raise that not to show how much assets we have versus MDBs or DFIs. I raise it to say we have to deal with scale. And we have to be very realistic about scale. So today we were talking about the taxonomies for central banks, the greener financial system, and I'm told that it's all under control. And it's going to crowd in private capital. I was asking them, which of my colleagues from the institutional investment community have you engaged in that taxonomy? Not a single one. So you're sitting in your public mindset where you've got a private capital mobilization track record that's on the floor. For every $1 of finance you provide, you're supposed to mobilize $10. You currently mobilize 20 to 38 cents. That is the statistic. But yet we sit here and talk about how can we crowd in the private sector. So I think fundamentally my message to governments is you need a different type of relationship. We describe it as climate investment statesmanship. We need to break out of a model where the math doesn't work. The math does not work. We need to fix this private capital mobilization problem. My good colleague from the World Bank has talked about data. We spent 10 years asking for the GEMS database to be opened and democratized. It's coming. Do you realize each year it costs our governments $15.6 billion a year in excess interest payments on loans waiting for your it is coming? We have crisis. You're costing us a lot of money with this it's coming. Why haven't you done it? You're betraying the trust of our governments. We're talking about governments now. This is the real problem about private capital mobilization. That's the data we need to be able to properly price the risk. That's the data we need to be able to crowd in our capital at scale. But you're saying it's coming, and you're costing our governments $15.6 billion a year, and you're saying that private sector is about profit and you're about development? This is the fundamental problem. There is not that genuine will to crowd in the private sector because there is a psychological and philosophical difference between the same institutions that live in the finance world putting themselves forward as the ones that can catalyze investment. And I think that is the message that we really want to send. If you need to be genuine and help governments have what we describe as an institutional investor-public partnership, a different relationship, because you can't blend, this is not a finance agenda, this is an investment agenda. We have to look at it at scale, we have to look at it over the long term, and we need the data that we've just talked about. You must democratize GEMS immediately, not it is coming. We've been asking for 10 years. I'm not sure that any bank is going to be offering to compensate the governments for all of that excess interest that we've been paying through various crises, through various pandemics, and also projects. We talk about nationally determined contribution projects. I participated in an event earlier this year with the Secretary of State from Germany and a number of others on the nationally determined contribution projects. What came out of that was very disturbing for governments, since we're talking about governments. They actually wanted to end the conference by saying they shouldn't be called NDCs, they should be called MDBDCs. Because they were saying that the projects are actually determined by the multilateral development banks because the governments were meeting the criteria of the technical assistance application to access the money to design the NDCs. Now we have a problem that the majority of the NDCs are not bankable in our view. So we as the investment community would say to governments, as you are putting it to us, we have the expertise to be able to support. When you have the Net Zero Industry Act in Europe, you don't have to apply and then wait 12 months for an application for project preparation, and then a consultant comes in. I think the climate champions described it as about 27 months to get resources. Well, in America, they're throwing money at the Inflation Reduction Act and things are happening very fast. In the last 12 months, they've mobilized more, $500 billion for climate, which is more than 10 times what Africa has raised in foreign direct investment in the last 10 years. Europe has the Net Zero Industry Act. But when it comes to Africa, we must apply for project preparation 9 months. And then, 27 months to get there. So there's a fundamental problem with the system. And I think that is really what I want to put out there and hope that our public sector, our development finance, and our multilateral development bank colleagues, we've had a massive summit. But yet we keep talking about finance, crowding the private sector. We can't give up a database that will de-risk our participation, that will enable us to do it at scale. And that's a no-cost reform. So I really just want to end on saying the reason I'm so emphatic on this is because this is the time. This is the year we have a new financial pact reform agenda. We need to reform. All of us need to reform, or else the planet goes to pot. We've now come with the Sustainable Development Goals review. We're now here looking at the big stock take. We must all take stock. And the approach to private capital mobilization is fundamentally flawed. And if it isn't, then instead of achieving $10 for every $1 of private capital mobilization, which is what you're mandated to do, and you're accomplishing 20 to 38 cents. I think that should be the writing on the wall. So let me just stop there as introductory remarks.
Thank you very much, Hubert, for taking us to Earth, even though the landing was not so soft, I would say. I'm so tempted to react. I will not. It's not my role.
There's a saying in a part of Europe. It says, I'd rather be smacked with a lie than kissed with the truth. Oh, excuse me, or the other way around.
Hubert, I dread to come to you now. No, I'm joking, of course. You know, you talked a lot about the need to find a way to invest to scale. I wonder whether that is also one of the challenges to get, in particular, institutional investors to invest into adaptation, because we often hear that adaptation projects are smaller scale and localized. Is that so? Or if not, what are the other challenges that you see for investors to get into the adaptation space with or without public financial resources?
Yes, no, thank you. I think it's, and please don't worry about asking me a question. I think it comes back to the same thing. A lot of the advice that goes into our governments, a lot of the strategic participation and alliances are linked to the capacity of the institution that is potentially providing that finance or providing that support, rather than the size, scale, or scope of the opportunity in the market. So I think we need to actually begin to look at what the real opportunity is. Our NDC should be investment opportunities rather than financial challenges. It's about how we look at it. Whether it's adaptation or mitigation, I think the fundamental opportunity, which could also potentially be the mistake, is that we seek to look at things project by project, asset by asset. The Inflation Reduction Act in America, which the European Union had to race after quickly with the Net Zero Industry Act, catalyzed institutional allocations. So an institutional investor doesn't have to look at a project or a fund per se. They can turn around and say, we can put a certain percentage of our portfolio into that asset class, which we know is going to address this issue. That is not what happens in emerging markets and developing countries. We need to make climate, both adaptation and mitigation, in Africa, in emerging markets and developing countries, a globally competitive, investable asset class. And that is not the expertise that sits within public sector development banks or MDBs. And that is why it hasn't got to governments, or it hasn't got to markets. And that is how you're actually going to get a percentage allocation from both domestic and global institutional investors. And when my dear brother from Uganda sort of talked about before we go outside, an institutional investor public partnership framework is predicated on a closer relationship between governments and the domestic pension and sovereign wealth fund, the domestic institutional investors who can then catalyze and crowd in where appropriate, where there's a plan, where their fiduciary responsibilities are being expedited responsibly. They can then crowd in appropriate capital. And then we can potentially, if we need and how we need, go for not blended finance, but blended investment, because blended finance has created a community that sell blended finance very hard, but there is an unintended consequence that comes with just being, too focused on one area. And I'll give you an example. So blended finance essentially, we're very sentiment driven in the investment community. If you tell us something, we'll listen and we'll hear it. So if you come to us and say, look, emerging markets, Africa, don't worry, we've got blended finance, we've got someone to take the first loss on the risk. Even before we've introduced the transaction, even before we've introduced the fund, what you're saying indirectly is, Africa and emerging markets, there's going to be a loss. You're selling us as a failure before we've even started. So I understand blended finance has an opportunity, it has a role to play, but what I often caution colleagues who are doing this good work is at the same time you're explaining that someone can take the loss, even before they've understood that whether it's likely to be a loss, whether it's de-risked or not de-risked, you've already branded us before, straight off of the bat, because you've got a mandate to do that and that's what you do. On the other side, all I caution is explain the negative cost of perception of risk. When you sell blended finance, you don't also sell how to manage the perception of risk. What does that do on the other side? Yes, it's $1 billion from pension funds, but what about the extra cost that we have to pay for capital because there is this inherent perception of high risk?
I think you should look at the structure. I don't think it's not very risky actually for Allianz. So
no, I'm not.
And there's not a lot of blended capital in it. I mean, there's not a lot of.
I'm talking about as an investor.
I'm sorry that I'm going to have to break this fantastic conversation, but we need to have a bit more time to close. Yes.
Yes. So I think it's a really important point because risk and the perception of risk is an issue, and it's actually institutions like the one you just mentioned that have said, we go out into the market to talk to investors with our blended finance platforms. And even before we've introduced the deal, we are told, for Africa, we need 20 to 30% blended finance. Even before they've looked at the transaction. So what I'm saying is, there is a connotation that comes with it, that it's important to know that that feeds into the perception of risk, which then ladens the continent, both public and private sector, with a premium on the cost of our capital. We live it.
All right.
Doing business in Africa, you can't afford to be without Africa Investor.